afternoon, everyone. My name's Steve Hyland. I'm the founder of Canacom Group and The Deep Dive, where we also have a YouTube channel where we make videos on mining stocks for retail investors. It's great to be here today to talk to you guys with something, or about something that is at the cross-section of my professional life and personal passion, and that is how do we identify opportunities in the often chaotic world of junior mining. To give you guys a little bit about my background, I'm a former math teacher. I eventually took the plunge into public markets, dissecting these companies every day. But despite my background and my time in the industry, I found myself in a trap that I think that many of you guys have found yourselves in before, and that is the trap of being jaded. Back in late 2024, I felt like the markets were broken and that mining might never truly come back. I remember looking at a company called 1911 Gold. They had a small permitted mill and a high-grade property, yet they were trading at a market cap of less than $20 million. My first instinct wasn't, I should buy this. My first instinct was, what am I missing? What's wrong? I compared them to a nearby peer, a nearly apples-to-apples comparison that had a $200 million market cap. 1911 was trading at something like 10% the valuation of their nearby peer. I had chats with the CEO, I saw that it was undervalued, and then I watched that stock go from 13 cents to $1.30. I'm a big believer in the Peter Lynch quote that investing is a simple game. Whoever turns over the most rocks wins. When we're at an event like this, you have a real opportunity to go and meet with companies and see opportunities and turn over rocks. Another one of those rocks that I saw that I thought was truly undervalued was a company called Orvana Minerals. They had a producing asset in Spain, an asset that was about to go into production in Bolivia, and a third asset that was equally impressive. Another stock I watched 10x without pulling the trigger. Those misses forced me to rethink my approach. I realized that if there was a way to understand these valuations on relative terms, I could overcome that jaded feeling and actually make informed decisions. That's when the idea hit me. We need to look at junior mining stocks exactly like we looked at baseball cards when we were kids. When you hold the Ken Griffey Jr. rookie card, you might be thinking, how much is this worth relative to a Barry Bonds MVP season card? Look at the stats on the back, the hits, the home runs, the on-base percentage. You go to nearby card shops, and you try to determine a value. The best thing is that when we talk about junior mining stocks, relative valuations are starting to matter again, especially in a market where things are starting to re-rate. Now, in mining, we do have stats, but if you go and talk to the CEO of some of these companies or watch YouTube interviews with them, you'll notice that they like to talk about colored maps, they like to use big words, blue sky scenarios, and basically do anything they can to divert you from thinking about things the way that I am proposing. I like to think about it like in football. I know I got a lot of sports analogies here for you guys. The offensive coordinator doesn't stand on the field. He works out of the second deck of the stadium. He does this because he knows that you can't make strategic decisions looking at the back of a helmet. You need to see the whole field. So when it comes to relative value, we need to have a starting point. What I like to do is break these companies into 6 distinct categories. We have royalty and generators, producers, developers, advanced drillers, companies with some drilling, and then lastly, we have what I like to call moose pasture. Once you have them categorized by stage and region, you can start looking at the stats on the back of the card. The drill meters and grade, the MPVs, the proximity to infrastructure, the development progress, and if they are producing, the cost of production, and how much they're returning to shareholders. Only then can we find the disconnect. Now, for the purpose of this presentation, my team and I went through over 120 mining companies in Canada. We literally put months of work into this presentation I'm giving to you guys right here. And what did we find? Well, we found something obvious. Lots of companies have already massively re-rated. But in our view, there are still many that haven't even started to re-rate. At this stage of the bull market, the producers lead the way, followed by the developers, the advanced stage drillers, and then the royalty companies. Which makes sense, because with royalty companies, you're almost always paying a premium for the reduced risk. But notice something odd about this chart. The riskiest companies are trailing. Now, are they always going to trail, or does that mean that there is a comeback trade coming? Today, I'm going to explain the general rules that I've developed for this trading card strategy. My goal is to move this from a guessing game to a systematic exercise in due diligence. And that is to say, in my view, junior mining is like a massive collection of trading cards. Some are common, some are rare, and some are massively mispriced because the collector hasn't looked at the stats lately. Now, what I'm proposing, many people here will tell you is crazy, because I'm suggesting we're going to remove the nuance while acknowledging that there is always nuance. And that's fine. The goal here isn't to make snap decisions. The goal here is to create a screening step in your due diligence for where you might see value. Okay, so first up, we have the royalty companies and the project generators. Now, I admit it's kind of controversial to put these two in the same bucket. You have royalty companies worth billions and project generators worth pennies. But I mix them because they're part of the same life cycle. A successful project generator is just a baby royalty company in the making. That said, the big royalty companies are the blue chips of this industry. They trade at a premium because they are the safest way to play gold equities. While a miner has to worry about the cost of diesel and labor, the royalty company just takes a percentage of the revenue. They get paid first. So how do we value them? We use something called NAV, or net asset value. To keep it simple, imagine you have a stream of payments coming in for the next 20 years. NAV is just a mathematical formula that tells you what that pile of future money is worth right now. If a company is trading for less than that number, it's said to be cheap. If they're trading for more than that number, well, it's said to be expensive. Problem? Everybody knows this. There are about 11 major royalty companies with Canadian exposure. The collectors are watching them like hawks, so finding a hidden gem here is very difficult. Next up, we have the producers. When we started this, I was actually surprised to find there are 24 publicly traded companies mining for gold in Canada right now. Now, this is another area the collectors are watching very closely. So what stats do they look at? First, you have ASIC, or all-in sustaining costs. Think of this like a golfer's handicap. You want to know, is it going up or is it going down? And where does the company rank relative to the rest of the field? For myself, I prefer a metric called EV to EBITDA. I know that sounds like a mouthful of alphabet soup compared to price to earnings, but here's why I and many others use it. We use EBITDA because it strips out the accounting noise, things like tax planning and amortization. This way we can see the raw earnings power. And we use enterprise value because it gives us a truer price tag. It accounts for the debt the company owes and subtracts the cash they have in the bank. But here's the catch. Because the market watches these stats closely, you are unlikely to find massive discounts without being a full-time analyst. However, there is a cheat code. I learned about this from Rudy Franck of Seabridge Gold during the VRIC Rule Symposium back in 2024. He likes to evaluate producers by asking one simple question. Are they a good custodian of capital? To answer that, you don't just look at how much gold they found. You look at their share count growth relative to their reserve growth or production growth. This is to say, how much did they dilute you to grow the business or even maintain it? And if you look at this chart here, you can see that Agnico Eagle stands out. That's to say that they diluted us the least in order to get us that additional production. And when we look at the returns of these four companies since 2007, what does it tell us? Okay, so this is where the real fun starts, the developers. With gold and silver re-rating so fast, net asset values are becoming tricky to pin down, but in a good way. We reviewed over 50 economic studies, and until just last week, we hadn't found a single Canadian developer who dared to include $5,000 per ounce gold in their sensitivity tables, which is basically where we're trading at right now. I'm talking at the high end of their sensitivity tables. The implication? Despite how far some developers have moved, there's still a massive amount of unrecognized value in these older studies. Now, of course, you can't talk about developers without talking about the Lassonde curve. This is the textbook time to invest, or they say it is, during the orphan period. That quiet lull between feasibility and construction. We believe that there are a handful of companies right now trading in that sweet spot. And if you can identify them, you aren't just buying a stock. You're positioning yourself for returns like the early investors in Lundin, Artemis, and G Mining. Now, I will say that this chart is subject to something that we call survivorship bias. If you are unfamiliar with the story of pure gold, it is possible to buy during this lull and walk into a zero. Next up, we have advanced drillers and dormant developers. Let's start with the drillers. These are your headline grabbers, the ones raising big money on big intercepts. But here's the reality. You can track drill intervals like batting average, but unless you have a serious geological edge, you aren't analyzing stats, you're gambling. So for us and the specific system I'm talking about, we step back. Where we do see an edge, however, is with the dormant developers. These are companies that completed an economic study but hit a wall, be it community issues, metallurgy, or just running out of cash. They are the damaged cards in the collection. Now here's why I like them. I have made the most money in my career in business when I've gone and solved problems. My thesis is simple. If a problem is fixable and the deposit is rich enough, someone will eventually fix it. Now, in this market, as you'd assume, these opportunities are increasingly rare. That's to say that the smart money is already at work fixing them. But if you look hard enough, there's still a few mispriced cards left in the deck. Up next, we have companies with some drilling. These are companies that have put drills in the ground and found mineralization. They found the smoke, but not the fire. They haven't had that company-making hit just yet to justify a massive drill program. But we actually love this area. Why? Because we believe there are companies in Canada that have hit great intercepts in recent years, yet the markets have completely forgotten about. We're talking about stocks trading at under a $10 million market cap with real data backing them up. I'm not here to drop tickers today, but I'm telling you, if you're willing to dig through the data and you have an appetite for risk, this is where you're going to find some hidden gems. You're effectively betting that the market will wake up and remember the story, and when it does, these stocks will move. And finally, we have a category we call moose pasture. These are your closeology plays. The shell with a dream plays. The companies pitching you on colored maps, grab samples, and how rich their neighbors are plays. I try my best to stay entirely away from this area. Why? Because even when the hype works, it gets dangerous fast. Look at Rackla Metals, a stock that hit a $150 million valuation without a single drill hole, only to crash 90% on early results. My view is pretty strict. I'll give these companies a $2 million valuation plus a little bit of wiggle room for cash. If they trade above that, I stay away. And if they trade below that, I'm probably still gonna stay away. Okay, so using the methodologies that I've just talked about, when you identify a potential winner, you need to look past the narrative. Focus on the hard evidence, like active exploration, permitting, and tangible assets like drill meters and mills. Ignore the flash of grab samples and esoteric metals that are one government policy change away from zero. Scrutinize the share structure. You want management teams that treat their equity with respect, not as a personal ATM. Assess management's competence by the details, even down to the quality of their news releases. But remember, despite the most talking point that every expert's going to get up on this stage and say to you guys for the next 2 days that management track record matters most, everybody still starts from somewhere. Also, if you're a small investor, you have one distinct advantage over all the big guys: agility. You can weave in and out of positions where others find themselves structural bag holders. Also, liquidity matters. We know that volume often precedes price movements, and stocks that do serious liquidity, like if we take a First Majestic, they're able to go and do great acquisitions at low valuations because other companies want the paper of the companies who trade. And ultimately, you want to expect nuance everywhere. Nothing in this sector is a guaranteed slam dunk. All right, guys, I'd like to thank Jay Martin for inviting me out here. I'm very grateful for this opportunity to get to speak with you all. And I'd like to close with this. I truly believe that we are in a unique window for precious metals investing. Last week, Canada's Prime Minister got up on stage at the World Economic Forum and said that the old world order is dead. So, for those of us, like myself, who are tinfoil hat wearing crazies whose families get sick of hearing about monetary policy at turkey dinners, I say this: our time has come. So ignore the hype, trust your homework, and go turn over some rocks.